Good morning and welcome to our webinar today called Getting Up to Speed on CfDs, a discussion on solar power and the coming auction, which is sponsored by LCCC. I'm joined today by Cam Whitten and Chris Hewitt from Solar Energy UK and Nick Blair and Gordon Edge from LCCC. And I'm Molly Lempriere, I'm from Solar Power Portal. We're going to start today with a couple of quick presentations followed by a Q&A, which will be very kindly chaired by Chris. If at any point you have any questions at all, just stick them in the question box and we'll do our best to get to as many as possible. I'm aware that we've only got 45 minutes today, so without further ado, I'm going to pass over to Cam to talk you through the solar pipeline in the UK and what it means for AR4.
Thanks very much, and good morning, everyone. Thanks for joining us today. So I've got a couple of slides just coming up here. So a bit of an introduction for those of you who haven't met me or don't know Solar Energy UK. I'm Cam Whitten, I'm the head of policy. We are the trade association for the UK solar energy industry. We represent about 250 companies now across the whole solar and energy storage value chain. And today we are, I'm just going to give a brief overview of sort of the state of play in the UK solar market currently, the overall pipeline, and then looking in a little bit more detail at what the pipeline for AR4 looks like specifically, just to set the stage here a bit. So, state of play, things are really moving. I think that's the bottom line. For folks who joined our webinar earlier this month, you will have seen greater detail on the deployment figures to date. We've built over 730 megawatts in the 12 months to date. This is up over 125% on the last year-to-year deployment figures. And we've now hit the point where we've deployed over a gigawatt, well over a gigawatt of subsidy-free solar, which I think is a real milestone for the industry in the post-subsidy era. So what are some of the drivers of this? Well, I think one of the biggest drivers, which is really relevant for CfDs and for AR4, is the analysis on levelized cost of electricity. So this is probably a chart that many of you are familiar with. This is the most recent analysis from BEIS on relative costs of power generation. And you can see that large-scale solar is already the lowest and projected to continue to be the lowest out until at least 2040 based on the latest BEIS analysis. This is one of the major drivers. I think there's a number of other drivers currently, not least of which being sort of the increasing focus on ESG across the corporate sector. But we'll come on to that a bit more, I'm sure, in the discussion to follow. So looking at the pipeline overall, we're now over 20 gigawatts of new solar parks being developed across the UK. So in some stage of planning or scoping currently. That's nearly double where we were 12 months ago. So really an incredible rate of growth in the solar pipeline currently, adding almost a gigawatt a month at the moment. So really stunning growth. Now the majority of these projects are still below the 50 megawatt threshold, which is as folks know, the threshold below which the projects go through the Town and Country Planning Act, and above which they go through the process for nationally significant infrastructure projects. But there are several larger projects that we're now starting to see entering the pipeline as well. So we've got a couple, 300 megawatt plus projects, one of which Cleve Hill folks will, I'm sure, be familiar with, has already been approved, and several of which are approaching approval. So that's the overall pipeline, and this is just my final slide, just to think about what this means actually in the context of AR4 in a bit more detail. So of that 20 gigawatts, we've got about 4 gigawatts currently, which we would call shovel ready. So that means they've got planning and grid, which is one of the minimum criteria for projects participating in the CfD. And if we look at that 4 gigawatts, if we look at sort of who's slated to complete within the delivery years for AR4, then we get to around 3 to 3.5 gigawatts of projects that we think are probably eligible to compete in AR4. So that's remember that number 3.5. I'm sure Gordon will come onto that momentarily, but that's basically the sort of the ballpark of what we're expecting the projects that are eligible to compete to look like. So with that, I will hand back or hand over to Gordon.
Thank you very much, Cam. I believe my glamorous assistant Nick Blair is playing the slide jockey here, but we're going to play a double header. I'm going to talk to you a bit about the CFD and LCCC, and then I'll pass over to Nick to talk about the milestones and the negative pricing. So really what we're about here today is letting you know what you're getting into if you sign for a CFD. We're the Low Carbon Contracts Company. It's important to point out we're a non-profit private limited company with all the shares owned by government, and we're set up that way so we can be the counterparty to the private law contract, which is the CFD. This has been a really important and successful structure in getting low-cost private capital into the renewable space. The amount of offshore wind farms investment in that has been pretty spectacular. And we've been considering that success when we recently refreshed our strategy, and our new vision and mission are about the wider acceleration of net zero. We see there's going to be a lot of activity in our core business, particularly with the CFD, with the commitment to decarbonise the power sector by 2035, sub-targets like 40 gigawatts of offshore wind by 2030. We're going to expand our contract management team quite spectacularly as a result of AR4 and the large number of contracts we're expecting from pot 1. So there's a lot of growth there, but we're also expanding into non-electricity sectors like industrial carbon capture and storage and hydrogen. So it's expanding the use of the same structure in order to get that investment challenge addressed through the use of the contracts. So I think we've been really successful in driving through that structure, and we're looking forward to really kind of bringing it back to the established technologies like solar. Next slide, please. So basically, when we're talking about the CFD, this really explains it all. In the auction, out of the auction, you will get a strike price. And the CFD is purely a financial arrangement whereby you either get paid if the reference price is below that strike price, or you pay back if the reference price is above it. Reference price in this case is the hourly day ahead auction price. So 24 hours ahead of generation, there's an auction. The price is set for each hour in the day. If you generate in any of those hours, you will get the difference between that hourly price and your strike price for the megawatt hours in that hour. So it's settled and really quite real time. It's settled daily, and you either pay or get paid quite quickly. So note the line underneath the negative line, which is you paying us. This line shows an early offshore wind farm with a high strike price. You'll be looking at something way down sub 50, I would expect, and therefore, especially given the kind of recent history, you should be expecting to pay back at least in the nearer term. So if we move on to the next one, we don't do the auction. We sign the contracts and manage them, but obviously we keep a weather eye on that, and I'll walk you through the structure of the auction and what you might expect from it. There are 3 pots in this auction. Pot 1, which is what you're mostly going to be interested in, the established technologies, primarily solar PV and onshore wind. Pot 2, less established technologies, which this time around includes floating offshore wind, and includes onshore winds as long as they're in remote islands like Shetland or Lewis, and also the emerging marine technologies, tidal, stream, and wave. And pot 3, which is new, all of the kind of existing fixed bottom offshore wind technology sits in there. So, okay, you have an auction. What happens in the auction? All of the bids within the pot, they're a sealed bid, sealed envelope bid. You write down the minimum that you will accept. That goes in. All of those bids are lined up in order of price, lowest to highest, and up they go. They're tested each time till they reach a limit, and at the limit it's pay as clear. The last project in sets the price for that pot, and in each of the 2 delivery years there may be different prices. What's the limit? Well, in the first instance there are budget limits. Skip to the next, Nick, thank you. So there are these monetary limits on each pot. Now, it may be difficult to understand what these 10 million, 55 million, 200 million mean, in which case what you have to do is look at the reference prices for the allocation. So if we have the next slide, this shows, next slide please. Now, if you look in the draft allocation framework, there are a number of different reference prices set for each technology or set of technologies over the years. What you need to focus on is that yellow line at the bottom there. You have the delivery years, 23, 24 and 24, 25. You also have valuation years for the 2 years beyond that. What you're looking at when you are trying to understand the budgetary limit, each project in has a set assumed load factor. For solar, it's 11.5%. For onshore wind, it's 42.4. You multiply that expected output by the difference between the strike price bid, or at least what the clearing price is at that point, and the reference price as shown here. And then for pot one, that means if you add it all up, if it exceeds £10 million, the auction is over. Now, important to note, I think most of you out there would be expecting to be below that line, but there's even better news than that, because that's in 2012 money, which is the kind of electricity market reform common currency. I asked around in the office yesterday, what's the multiplier between 2012 money and current money, and it's about 1.5. So you're looking at prices, the reference prices being kind of north of £60 a megawatt hour in current money. And I would fully expect people out here today considering bids to be less than that. But bear in mind, when you put in a bid, it needs to be in 2012 money, and that's considerably less in nominal terms than today's money. But bear in mind, therefore, most bids are going to be less than these reference prices. And if bids are less than reference prices, you can have an infinite amount of capacity as a result, because it's less than zero. Therefore, the £10 million budget for pot one is likely pretty irrelevant. What's really going to be important is the capacity caps that government has imposed on the auction. And if I have the next slide, please, it's not too difficult here. Pot one is the only one with a capacity limit. The other two pots are just limited by the budget. If you note, in the other reference prices, they do drop much more in later years, and therefore there may well be budget usage as a result in those technologies, in those pots. But in pot one, it's unlikely to be needed. Government has set a cap on the pot of 5 gigawatts overall. So if at any point the amount of capacity that results from lining up all those bids hits the 5 gigawatt limit, auction closes at that point. Underneath that, there are sub limits for onshore wind and solar of 3.5 gigawatts each. So if in the process of lining up all those bids, the capacity of one of those technologies hits 3.5 gigs, then that stops for those technologies, but it keeps going for everyone else. So, and they get a clearing price, which is what it was at the point where they hit that limit. As Cam's pointed out, if the solar pipeline is only up to 3.5 gigawatts, then that also is unlikely to be hit for solar. But you bear in mind, you are in competition with onshore wind. At some point, you may hit that. You're probably going to get less than 3.5 gigawatts, depending on whether you are how competitive you are with those onshore wind projects. So that's really a very quick whistle stop tour through what AR4 auction parameters. There will be more. There's the final parameters will be published shortly, and we're looking forward to seeing lots of you bidding. So that's me, and I'll hand over to Nick now to talk through some more of the detail on the contract.
Perfect. Thanks, Gordon, and good morning, everyone. So as Gordon said, going to have a bit of a whiz through some of the key parts of the contract if you are successful in allocation round 4. I guess a couple of important things to note. I'm going to whiz through because we do have a more detailed sort of pack on this as we went through the launch event, so that's all online. So perhaps people have already seen this, but I think hopefully it raises some questions that people might have, and also there's a couple of key points at the end that I think are worth discussing too. So again, really very much open to questions on this, and the key factor is, if you are successful in getting a contract through AR4, we have a great team of contract managers here, as Gordon mentioned, and a big chunk of their job is to help you get through these processes smoothly. And alongside that, our intention is to be running more webinars to dive into some of these in more detail, because we're aware, certainly for some of the solar pipeline, that you might be looking to move through these dates quite quickly, particularly as the auction round is open to part built. So this really just gives the general overview. So once the auction's done and dusted, it's our responsibility to get a contract out to you. And our intention is that we send a draft out, we make sure there's no glaring errors in there, and then we aim to have that signed within 20 days. What you're then into is the initial conditions precedent. This is quite a light touch, but it's really just to show that you understand the contract that you're getting into, and for us to understand the general layout of your project. Milestone delivery date. This is really about ensuring that your project is underway and going. We'll talk about that, what that means in a little bit more detail. Operational conditions precedent. So this is the first time at which you can earn some money under the contract, as you can basically start to export if you're nearly completed with your build. And then your target commissioning window is where you will be aiming to have your project fully live. You'll notice on the graph to the right there's a bit of a variance in the Longstop date for solar. The Longstop date is 12 months beyond that target commissioning window. So the initial conditions precedent, as I said, this is the first thing to go through after contracts are signed. You've got 20 days to do this, which should be enough time, but the key thing is, and we would welcome any early engagement on this, because if you're expecting and you think you're going into the auction with a good price and you're confident of this, by all means reach out and discuss if there's anything you're worried about in here from what you see, or you just want to make sure that you've got all of those details good and ready to go. We'll be more than happy to have a chat, and as I've already said, we will be running further webinars on this much closer to the time once the auction timelines are much more clear and we know when we're going to be signing contracts. So it's made up of 3 parts. First is legal opinion. So this is having a external legal make sure that the contract is explained to you and understood, and that you're able to deliver it. Evidence of compliance with LCCC's Know Your Customer. So this is basically one of our teams here doing some checks and research into your company, and we outsource that to another company. And then facility description for solar. This is really quite simple. We'll be publishing some updated guidance on this once the contracts are finalized, so towards the end of November, early December. And we've been pretty prescriptive on what you need to provide here. It's really around explaining to us the number of panels, any other sort of key auxiliary equipment that you have on site, what the rating of the panels is. But the key thing to note, actually, this is a first indication, and these things can move. We understand that as you go through a project, but it's to show us your thinking at the time of signing the contract. You'll notice as we go through these slides, we do have to put it in there. All of these milestones come with a right for us to terminate the contract if they're not fulfilled within the timing. And whilst we'd always say, look, we strongly advise you to make sure that you can get all of this done, it's not in our sort of operating model to want to go about cancelling and terminating contracts. That would only happen where we really see a complete lack of ability to comply with what the contract is asking. And particularly, if you're coming in saying you can get a site built within 2 years and actually that looks like 10, that would be quite an extreme scenario. But the key point is we are here to help. It's the contract management team job to help you through these processes, and we really don't like having to terminate one. So work with us, keep the communication lines open, and hopefully everything goes smoothly. So that first step after the initial conditions precedent, so this has been extended to 18 months post review and challenge allocation round 3, but it's basically to show that the project is underway, and there's 2 routes to do that: either show that you've already spent 10% of the budget, or to have those key supply contracts entered into. You've got your rights and consents. Some of the stuff that's perhaps a little bit different is that at various stages of our milestones, we do ask for director certificates from the company. So this is basically a sign off from your directors to say that the information being given is accurate and correct as the board understands it. And again, the point around termination rears its head. So this is OCP, operational conditions precedent, is the big one, because this is where you can start to earn your money. So you can do this from anywhere at the start of the target commissioning window, and basically it's a lot of the information that you would be providing, for instance, for your grid connection and tests, but there is more beyond that. So there is a list here. I'm not proposing to read through it all in detail, but one of the key factors is that you've got at least 80% of your install capacity estimate ready to go, and ready to export, and by that we obviously mean having the grid connection in place to support that export as well. Some obligations around metering. So we have our partner EMRS that will help us from the metering side, and again they'll help you with what you need to show. They've got their own set of guidances on their website. Communications, some specific stuff around embedded or distribution connected generation. So it works slightly differently compared to the transmission connected, and then your compliance with your grid connection as well. And then you've got the target commissioning window and your Longstop date, and this is where you are then looking to get your final install capacity set up. Once you hit your start date, that is the go on your 15-year term. So not your operational conditions precedent. That's if you like, a bit of a lead in. But yeah, once you've hit your start date, which can also be at the start of the target commissioning window, you begin your contract. If you are not ready by the start date, then you do go into contract erosion after the end of the Longstop date. And the required install capacity for this is to have 95% of your final install capacity. So again, this is just a point. This is kind of, if you like, the final bit. So you've got to have declared your final install capacity by no longer than 10 days after the Longstop. Your final install capacity can't be higher than your initial install capacity estimate, but it can be lower. But that, again, as stated on the previous slide, 95% is the cutoff there in terms of the final install capacity versus the installed estimate. So this is all about making sure that you're essentially not building more plant for your CFD than you initially intended to, because as you'll be aware, in the auction parameters there's assumed load factors which feed into the budget. There are options for overplanting and having merchant capacity on the same site. Again, that's something that you should look to discuss with us. We have to do some calculations and really look into making sure, again, that the consumer only pays for that right amount that was expected under the initial contract. So I've mentioned a couple of times around guidance. Some of you may be aware, some of you might have looked at this. The contract is a large contract, And it's obviously been made to apply to quite a lot of technologies. And in some areas, it goes into quite specific detail around what's expected from the different technologies. But in some cases, it goes less into the detail. So what we've done over the years is to really pad out what this means for specific generators, or what general terms in the contract that apply to everyone mean in a little bit more detail through the route of guidance. I think the key point here is that solar hasn't been in since allocation round 1. And actually, a lot of the work that we did on our guidance document, we engaged a lot with the wider industry to build this up with external contractors and experts to kind of help us understand what was the right stuff to be checking. A lot of that was done during allocation round 2 and leading into allocation round 3. So where we are today is that we actually don't have a highly specific set of guidance relating to solar. As I said, we've got the initial conditions precedents piece done, and we'll be publishing that soon. But I think what I'm saying here is there's an opportunity really for us to engage with you on this as we look at the milestone requirements, as we look at the operational conditions precedent, final install capacity, what's expected, what's that paperwork that's going to be required. And we'll be looking at this in more detail going into the new year. So look out. I expect that we'd look forward to running some webinars or workshops to kind of talk you through our thinking on this, to get your feedback. Obviously, everything's always more than welcome in that regard. We want to put something out there that's really fit for purpose and that's understood. And clearly, we have time between the bid round opening and the contracts getting signed where we can do that. So as I say, we'll be getting some stuff out towards the end of next month, early December. And from that point onwards, we'll start thinking in more detail around those wider ones. For now, you'll get an indication from looking through some of the other guidance documents that's there for onshore wind, offshore wind. It would certainly give you a good idea of the kind of information that we're going to be asking for. And, solar is really one of the more simple technologies for us in doing this, certainly versus some of the energy from waste plants and things like that, which you can imagine are much more complicated considerations to think through and commissioning. So yeah, more than look forward to engaging with you on that as we go forwards. So that was all I was going to say on the contract processes. And it was asked just to put a slide in here just to sort of remind and reiterate around negative pricing, but also actually to give you a little bit of good news regarding storage. So you may or may not be aware, when the first contracts were signed, there was always this thought that the CfD would push us into this world of negative pricing in some regards, but it was not included as a reference and in a term in the first contracts. However, once we moved towards AR2 and then into AR3, negative prices were becoming a real thing that were going to impact the system. And the decision was taken at that point in time that where there was a period in the reference price of negative pricing for more than six or more hours, that CfDs would no longer receive payment during that term. For the FIDA and AR1 contracts, they still continue to receive their strike price, but in those periods, but that is from a reference point of 0. So for instance, in the graph there, where you've got it going from -10 up to 60, they're not getting paid £70, they're just getting paid from 0 up to 60. The change being made now going into AR4 is that any periods of negative pricing in the reference price, which is day ahead market, will not be paid CFD. So that is obviously something to bear in mind when preparing your bids and kind of looking at what we've seen over the last summers and what we might expect to see going forwards, and just really to be cognizant of, because we wouldn't want it to take you by surprise. So flicking on to, I promise, some good news. Again, this is something that's well known to our current contracts. I don't know how well known to yourselves, but there is a clause in the existing contracts around prohibiting co-located storage alongside a facility unless it's under a separate BMU. Now, the rationale for this in policy, because a lot of this policy intent was set several years ago and is thought about on an ongoing basis, the rationale there was just to protect consumers. What BEIS didn't want to happen was that you would have perhaps somebody importing power into their storage off the grid and then somehow managing to export that and gain CFD revenues from it at the same time as from their CFD asset. So the clause is a bit of a catch-all and a bit of a lock, and actually really quite a prohibitor to the uptake of on-site storage. The feedback we get quite often is, it's difficult to set up a separate BMU and cost prohibitive as well, certainly against what are still challenging business cases for storage. So over the summer, my team have been having discussions with generators, with BEIS, and trying to find a way through this. This is a good thing about LCCC having this bilateral contract relationship is that where we can show that a policy intent is perhaps not being met as was required, or is perhaps there's a little bit of overkill going on there, that we can look to amend that. And that's precisely what we're going to be doing. So there's a little bit ahead of the curve, but I wanted to throw it in there. With the guidance should be getting published in the next couple of weeks, but it's all been agreed and signed off. So we'll basically be saying that we're open to changing this clause within a contract on a bilateral basis for a side letter or through an amendment agreement to the contract. But that will come with a few asks, and that is basically that you can show us your metering setup that meets the sort of fiscal requirements under the CFD for payment. And the key point is that we are only ever shown to be paying on the output of your connected assets, so obviously solar in this case. And so there's clear differentiation between the metering of the output of your CFD assets and the storage. We haven't been as prescriptive to say exactly what this looks like. What I would say is, again, we have metering experts who are contracted to us, EMRS, and we'll be looking to them to really assist us with those. So this is going to be about having a dialogue, about opening the door with us and having those questions. What I would say is we have precedent here in terms of metering setups, because some of you might be aware that there's private wire arrangements under the CFD possible as well, which obviously fall outside of BMU metering. So we know there's metering options there. I think what we'll look to do as we progress with people and as we start to see solutions coming through and getting an idea of the kind of metering solutions people propose, we can certainly add that into the guidance going forward. But there's a little bit of here, it's look over to the experts somehow, come and show us how you'll do it, and we will work with you to get that over the line, because ourselves, BEIS, we really recognise, particularly with those negative pricing aspects, the value that storage can add to your solution. So finally, just a little bit here about engaging with us. I do recommend that you go onto the CFD microsite, cfdallocationround.uk. You can sign up and subscribe. You'll see any webinars that are upcoming there. We're running one on the 3rd, for instance, 3rd of November, which is around the minor and necessary process, which kicks off next month with regards to contracts. Similarly, on the LCCC website, there's all sorts of information available, those guidance documents. I've mentioned our own news and events. And as we get closer and closer to the bidding window, you'll be seeing more and more from us, because what we want to do is make sure that you hit the ground running if and when you get one of the contracts. So that's my part done. Thanks for listening, and I think we'll be opening up some questions.
Thanks, Nick, and thanks, Cam and Gordon. I'm going to pass over to Chris now to chair the Q&A. If you do have any questions or anything else that occurs to you, please do just stick it in the questions box at the side. Thanks.
Yeah, no, thank you. Thank you. But yeah, all speakers really helpful. I just want to clarify. I think we got until 11:15. Is that the time? I'm conscious that we don't have that long questions. So really encourage people to put those in the chat. I guess if we have a whole range of questions, we might be able to string it on for a little bit longer. But I've got a few, but let's just dive straight into one which has come up from Alex McGregor there on the chat, which is I think for Nick. Which aspects of the facilities description are able to be changed at a later date? For example, cabling route.
Yeah, the short answer is pretty much all of them.
Right.
it's to show
Nice
that
answer.
you've got a plan there in place, but it needs to be grounded in reality. You can't just show us a site that's in another part of the country with some child's drawings on a piece of paper. But look, we accept and acknowledge that stuff changes as you move for a project. This isn't about tripping you up. It's just about showing that you have at least done that initial thinking, and that you've come into this with the intention to deliver a site. Again, we will work through any problems and issues that you have as we go through.
Great, thanks. And also, a quick sort of technical one is you've got lots and lots of webinars with lots and lots of detail. We're obviously not going to be able to cover a lot of that. Are those webinars also you can watch them later? Are they sort of on demand as well?
Yep. So you can certainly
Really
everything that I ran through quickly there. My team go through in much more detail because they know more about it in when we did the launch event. So that would be a good place to start. And yes, the minor and necessary, for instance, will be recording those. I don't know what else we have at present, Gordon. I'm going to hope. Do we have historic recordings? I know we started recording a lot more during lockdown because everything became webinars rather than face-to-face stuff.
Yeah, we have a backlog of webinars primarily aimed at people who already had CfDs, but there may be information there. We have some like the recording on the launch event, which is aimed at people who are looking at bidding, and there'll be more of that as we go on towards the bidding window opening next year.
Great, thanks. There's a question from. Yeah, go for it. Yeah.
I was just going to follow up on my response to Irvin's, well, now two questions. Yes, the budget cap is in 2012 money. It is adjusted for inflation. I mean, you have to put bids in 2012 currency, which is just one of the complications of EMR. It's just so they could have everything in the same cash over years, so it's consistent. But it does mean you have to think about what the inflator is. My understanding is it's about 1.5 from 2012 money to current nominal. So that's worth remembering and getting the numbers right there. On the initial question about budget cap, one thing I'll point out is the arrangements for the auction are a bit artificial. They're only doing a very prescribed calculation on the basis of some forecasts, and only for the valuation years that there are. Beyond that, it's ignored. And actually, once we've signed the contract with you, that all those numbers are irrelevant. We are committed to paying you or being paid on the basis of the actual reference and strike prices as done. So whatever it says in the auction goes out the window at that point. It is what it is at that point. We are committed to paying that. So really, it's a bit artificial for the auction. But as I said, if you're bidding under the reference price, all that budget stuff is irrelevant. It's the capacity cap that's the important thing. And bearing in mind that you need to write down a bid, which is your minimum acceptable price. If people bid higher than you and are successful, you will get their price. It's pay as clear, so it's all gravy after that.
Thanks for that clarification. So, got a question from Hitesh Bharti around the tentative timeline expected between the CfD auction results and when the actual commissioning of the project takes place.
Well, that's really up to the developer. When you submit your bid, you're submitting a target commissioning date with it in one of the two bidding years, which are 23, 24, 25. So 1st of April, 23. So you get to choose that date. You can there's a window that goes around that, and you can choose how that window, 12-month window, goes around that date. So the date could be at the start of the window, it could be at the end of the window. So potentially you could bid a date of the 1st of April 2023. You could make your target commissioning window so that date is at the end of it, and you can commission during 22-23 if you're able to do so. It's entirely up to you. There's a lot of flexibility around that. So really it's up to your choice as to how you play that. Nick talked about the milestone delivery date. You can do that earlier than the 12 or 18 months that you've got available. It's really up to you. If you want to get stuff done really fast, it's possible. I don't know if you want to follow up on that, Nick.
Sorry, Chris, just want to add one thing to that. Yeah, there's a key point. Whilst when I talked about on my slides being able to earn money from the start of the target commissioning window if you do your OCP, what you can't do is earn any revenue before your delivery year. So whilst you can go through those processes and you can go through the OCP in advance of the earliest being April 23 for solar, you wouldn't be able to earn any revenue to start under your CfD contract until you hit the 1st of April, because that's the budget year for it. If you were obviously aiming for 2024 on your delivery year, it's then a little bit different.
Just on the follow-ups in that question, all the results are public as soon as the auction is validated and Secretary of State signs it off. They're all out there.
Is there an actual date fixed for that, or is that?
It depends. It depends on whether there are appeals through the eligibility process. If you look at the microsite that Nick mentioned, the CFD allocation round, we've got a shortest and longest timelines, and that shows you when you can expect to see it. It'll be in a window between about March and about June, but that's the when we expect the results to be out.
So
we know
March,
will
March
be
to
within
June
that.
2022.
Yeah.
Okay. Just a very quick one from Claire McCarrick where can you, is the inflator sort of, is that something which is in your sort of websites, which the current, because obviously that will change. So what's the reference for that?
That's a good question. I asked, like I said, internally within our office, but I think it's a good point that we need to be putting that somewhere public. I'll take that away and make sure that happens.
People are going to be thinking about quite a lot.
Yeah, it's not a simple answer, is what I've found when we've looked into this before. So yeah, we can come back with something and point in the direction of
that would be very helpful.
Good answer for that.
So I had a question around, perhaps bringing Cam on this as well, around so I think it's really helpful that you're adding that sort of flexibility on storage. I think that's because clearly, what we know is all developers of solar are looking at a storage option. They may or may not be putting storage on their site, but they're certainly looking about it and thinking about it. So do you anticipate, and Cam, whether you would anticipate that would increase the interest from solar developers, and perhaps people in the chat, whether they would agree?
I mean, my understanding, certainly from when we went through the initial consultation phase, the negative pricing element itself was seen as a driver for co-location. So the fact that you can now, with those tweaks, that you can disregard the prohibition on co-location, if you can demonstrate the appropriate metering arrangements, I think that's a really welcome change. I imagine that we're going to see a lot more projects seriously considering storage additionality as part of their proposals.
I suppose a supplementary to that for Gordon is, I think you mentioned that projects can bid for a proportion of their output. So if you have a large plant, you can say, okay, 100 megawatts of this we're going to put into CFD, and the rest we'll do as merchant. In addition to that, can you also have portfolios of projects? So if someone's got 3 50-megawatt projects, could they pull that together as one bid, or do they all have to be separate bids?
No, they all have to be separate, I'm afraid. It's a long history behind that idea, but in order, there are sort of proposals around that when I was on the industry side of this, trying to go, well, okay, if we need to justify putting out large grid infrastructure, and you have a number of projects at the end that may or may not win, if you put them all in a package and say, make it binary. If they all win, then they all win, and if they don't, they don't. But no, it's just too complicated, and we've seen that with AR3 with the remote island wind projects. None of the individual islands reach the thresholds that Ofgem had set to justify building new grid infrastructure, and so they're stuck in limbo until more projects come forward, hopefully out of AR4, and justify the investment in the HVDC links out to, say, the Western Isles or Shetland.
Okay, so in terms of transaction costs as well, so you can imagine, okay, yeah, if you've got 350 megawatts or something, you might want to split that into two and bid some in for CFD and others. But at what point, I mean, how small do you anticipate these contracts could get in terms of megawatts? Could someone bid in 30 megawatts of their 50 megawatt project, for example? Or is that worth doing?
It's entirely up to people if they want to do that. If it pencils out for them, we have absolutely no problem with that. We have already one example. Okay, it's a different scale, but the Sea Green project offshore wind farm out of AR3, if memory serves, it's 434 megawatts out of 1,050 have a CFD, and the rest of it is merchant. SSE went ahead. SSE and Total, who own that project, went ahead on that basis. So they have a kind of partially fixed, partially floating revenue, and they were happy with that. So and we can accommodate it. It's fine.
I suppose maybe it's a question for Nick. Then it's about the transaction costs of the contract and how much is it. Do you think it's going to be worthwhile someone putting in a contract for tens of megawatts of a partial one?
Sorry, Chris, when you say the transaction costs of the contract,
so say I'm a developer with 50 megawatts a project. The option is you bid in for the whole 50 megawatts, or you think actually I'm quite interested in the merchant side of things. Perhaps I'll bid in just for 20 megawatts. Do you anticipate that being worth doing in terms of the process that has to go through to make that contract work?
Yeah, so the difficult thing we get with smaller projects is that it is a large contract. We have this legal opinion piece, and clearly that they're checking through a 400-500 page document when all is said and done. But I think, as we said, yes, there are things above and beyond what you would standardly be doing for commissioning of your assets and getting them onto the grid, but it isn't a long way beyond. It's not like we're asking you to go out and produce reams of extra support from external consultants and things like this. It's more around some of those director checks, additional information on the specific nameplates of your pieces of kit. So it is all stuff that you would probably have anyway. So it really comes down to probably that first piece and the costs involved in getting the contracts checked and getting comfortable with it. Again, we are here to help with getting through the contract, and any project that can go from start to finish to get live on the grid shouldn't be hitting any problems with meeting their obligations under the CFD.
Yeah, well, I definitely encourage any people on the call or thinking about it to bite your hand off on that one, and definitely call Nick or his team to talk this through, and that's really helpful to have that open door.
I'm afraid
Molly, the time is up on you.
I'm afraid the time is up, but thank you very much for chairing the Q&A, Chris. It was really interesting, and thank you, Gordon, Nick, and Cam, for your presentations. I'm sure if you do have more questions, if you reach out to any of the panelists, they'd be more than happy to help you. But yeah, thank you very much for joining us today, and thank you for watching. Thank you for your questions. Thank you for your presentations, and I hope you all have a really lovely Tuesday. Thank you.
Thanks for having us.
Cheers.